because your boy is excited to teach you all about the investing world. But anyway, the first step when it comes to investing is you're gonna have to select a brokerage platform to be able to invest in. There are many different brokerages platforms, but I'm going to advise everybody that for your first investment account, it should be in something called an IRA, an individual retirement account. The reason that I say to open an individual retirement account, particularly a Roth individual retirement account, unless you are close to retiring and you're like, I'm not going to be in a different tax bracket than I am right now. Open a Roth IRA, start putting money into that account, because this is a tax-free account. This is how you actually avoid taxes, because not only is the money that is getting put into this account going to grow tax-free, also every year on your tax refund, you can deduct your taxes. In other words, you can reduce the amount of taxes that you're paying because you're investing into a Roth IRA account. And so you can get some more money back from the government whenever they take money out. So that's something that you should be trying to do every single year, is invest money in an IRA account. Now you can go to different platforms to do it. You can open one with, my preferred is Fidelity, just because I've been with them since 2015 because of a co-op opportunity that I have. You don't know what a co-op is? A co-op is where you work for a company full-time while you're still in school. It's kind of like an internship, but a lot more in-depth. But anyway, I started with Fidelity and I've stayed with Fidelity. They've been very good to me. Every time I called them up, they always answer me. You can also go with Vanguard. Vanguard is literally the industry standard because of how low their fees are. And then you can also go with something like Charles Schwab, which is the other top-rated one. All three of these have great, wonderful customer service. Of course, you can also go with other platforms like M1 Finance, which I also love M1 Finance, but I just don't do my Roth IRA with them. I do my brokerage, my actual taxable account with them. So just my regular brokerage trading account, I do it with M1 Finance. So there's a bunch that you can select, but the main thing that I'm going to make you pay attention to is customer service and security. Customer service and security. The great thing about Fidelity, Vanguard, and Charles Schwab is if you have any questions, any point in time, whenever you want, you can pick up the phone, dial a number, and they will walk you through every single step of the way. So that's why I advise most people to open either a Fidelity account or a Charles Schwab account or a Vanguard account. I opened a Vanguard for my parents. I have a Fidelity account. My little brother uses Charles Schwab. They're all basically the same thing if you know what you're doing in them. Vanguard is the easiest just because their fees are super low. So every single thing that they offer to you is cheaper than when you compare it to like the Fidelities of the world or the Charles Schwab of the world. Now, the second thing that you have to determine for yourself is, how much do I need to be investing, or what is the goal? Like, one of the things that I love to say is, you first of all have to know some kind of goal for yourself. You first of all have to set some kind of destination that you want to reach for, because if you don't have any destination, then you're just kind of going all over the place. You're just kind of like, oh, maybe I'll go this way, or maybe I'll go this way. You just be lost, right? You just have no idea where you're going. You're just gonna get lost. I mean, sometimes it's good to just drive around and just to see the scenery, but that's not what we're trying to do with this retirement account. We want to set ourselves a goal, and the easy way to know what goal you need to set for yourself is there's something called the 4% rule. And the 4% rule states that if you withdraw 4% of your portfolio, you will never run out of money. If you have every year you withdraw just 4% of your portfolio, you will never run out of money. It's very much like a shorthanded rule. It's not good for every single situation, but it gives you some kind of guidance to get you started off on your journey, to start planning for the day when you don't have to work anymore, to start planning for the time when you can completely buy your freedom back from your work or from any of the other things, where you can do whatever it is that you want to do whenever you want to do it. The way that you calculate with the 4% rule is figure out how much your annual expenses will be. So figure out how much you will need to spend every single year moving forward. Let's say, for example, you spend $25,000 every single year, and then you multiply that 25,000, we're going to do it on the computer, by 25, because that's basically the opposite of 4%. So you multiply that by 25. So if you retired, you only need $625,000 invested in the stock market, which you get in a 4% dividend off of that, and you will never need any more money. Typically in the United States, the average cost of living is about $40,000, which if you multiply that by 25 is $1 million. So you need about $1 million on average to be able to live off of the dividend payments and never have to worry about paying anything or worry about your money ever running down. So just figure that out for yourself. How much do I spend every single year? And that's like the base minimum expenses. That's not basically like, I want to buy a new house, I want to buy a new car. All that kind of stuff is extras. So also kind of factor that in to get to some kind of estimate. So maybe right now you're single and you only spend about $40,000 a year. Maybe factor in, I plan to get married at this point in time. I'm going to have a house. I'm going to want to send my kids to college. So maybe I should double that amount. So maybe I'm going to need to be around the $80,000 mark every single year. And if you multiply that at 25, you need to invest $2 million or have $2 million invested and getting an annual return of about 4%, or rather getting a dividend payment of about 4%, so that I never have to run out of money. Now that you know how much money that you need to be saving, two words, on investor.gov, they have a compound interest calculator, and you can figure out, it gives you the opportunity to start with a savings goal, and then you can actually figure out how much you need to be depositing every month and how long you need it. So let's say our savings goal is $2 million, right? And our initial investment, we don't have anything right now. We have $0 in our, and we have 40 years to be able to grow to have that $2 million invested. And we're estimating that our interest rate will be about 8% after we take out inflation. You know, inflation is about 2% every year. And we said that the stock market goes up about 10% every single year. So 8% is our inflation. So if we wanted to reach, we'll have to save $643 every month to be able to get to $2 million in 40. And then you can play around with it. You can be like, okay, I want to do it in 20 years. How much do I need to be saving right now if I don't have anything saved? Then you need to save $3,642.03 to be able to get to that goal in 20 years. So it gives you an estimate to be like, okay, this is how much I need to be saving. This is how much I can expect to have in return. Okay, how can I mitigate my lifestyle to ensure that I get to that destination, right? You start making plans, because a lot of times when it comes to things like retirement that is so far in the future, it's hard to think it through. But this gives us something concrete that we can hold on to actually think through the way that we have to go in order to invest and save money for our retirement and get to the point where we can say we are financially free. But anyway, the last and final thing is, after you've opened up your Roth IRA, what you're going to need to invest in within your Roth IRA is something called a Target Date Index Fund. Because if you're like me and you're extremely lazy and you don't want to spend too much time thinking about this stuff, this is literally the easiest way that you can start investing until your investment life gets a lot more complicated. But for right now, for a lot of us that are just starting out, this is literally all we need, for real. We don't need that much complications with our investments. We just need something that will just compound over time for us, something we can just passively do without really thinking about it too much, where we can just kind of have our money going into it every single month and being invested on our behalf automatically without us having to think about it. And the beautiful thing about a Target Date Fund is the fact that it has everything in one. This is the beautiful thing about it. It has large cap companies. Actually, it has like the total stock market. It has large cap companies. It has mid cap companies. It has international companies. Then it also has a little bit of bonds exposure in there. So you have everything. And as long as the world economy keeps growing, your investments is going to keep growing. As long as people keep spending money in the economy and people keep living life and our life expectancy doesn't start declining and people keep innovating and all that good stuff, you will continue to grow your investment. Unlike when you're trying to pick single stocks, you have to know about the company. You have to do all this other research that takes a lot of time. And for most people, they don't have the time to spend trying to figure out all these detailed stuff. So you can go search for different target date funds. For example, Fidelity's Target Date Index Fund is called the Fidelity Freedom Index Fund. It's very important when you are searching for these things. It's very important that you look for that index number. That index number is very important because otherwise you'll be paying expensive fees, and we ain't trying to pay no fees. We want this thing to be passive and cheap. The two numbers that you're going to look for whenever you're looking at any of these index funds is the gross expense ratio and also the turnover rate, because the turnover rate shows you how often they're taking stuff in and out of the account, and then the gross expense ratio tells you how much in fees you're going to be paying. So typically you want the fee to be below 0.2% and you want the turnover ratio to be below 20%. So the three examples that I have that everybody can go look up depending on which brokerage you open up, because these are all brokerage specific, If you have a Vanguard account, you're going to just look for something called the Vanguard Target Retirement Fund. Like I said before, Vanguard is actually really good with their pricing, really good with their expense ratios, really good with not charging you too much money. So on Vanguard, it's just called the Vanguard Target Retirement Fund. For Charles Schwab, it's called the Schwab Target Index Fund. So make sure that index word is very important. It's very important. So Schwab Target Index Fund. And then finally for Fidelity, like I said earlier, it's called the Fidelity Freedom Index Fund. Now, the important part of it is you see a lot of them. You see a bunch of them. Some of them have the year 2050 on the side. Some of them will have 2060, 2040, 2070. All those are the date of your expected retirement. And the easiest way for you to calculate that is your birth year plus 65. Now that's one way you can do it. Of course, if you want it to be more risky, you can add more years in order for it to be more risky. If you want less risk in your portfolio, then reduce the amount of years, because then it will add more bonds into your portfolio. But the main thing is you want that annual, you want to figure out what year you plan to retire. It's a very simple way to set this up. Now, for each specific account, whether it's Charles Schwab, Fidelity, or Vanguard, each one has a way for you to set up their automatic payment, automatic transfer, and automatic investing. I can't go through all of them because I don't use them that often, but I do have one for Fidelity, like I said earlier. So you can check out that video. It's in the show notes, so you can go check that out. But anyway, that's literally it. It's pretty straightforward when it comes to investing. It's not that complicated, in all honesty. It's very simple. I know it feels very complicated when you first get started with it, when you first start thinking about it, but when you simplify it, when you sit down, go to that investor.gov calculator and figure out how much do I actually need in order for me to retire, then you can figure out how much do I need to be putting away every single month in order to be retired at a certain date. Once you figure all of that stuff out, everything just kind of gets mapped out, and it's pretty simple and straightforward from there. But anyway, that's all I got for y'all in this video. I hope y'all learned one, maybe two things out of this entire thing. And if you did, leave a review for this podcast, or leave a comment down below if you're watching this on YouTube, and give me them 5 stars, 5-star review, or any on the podcast listening platforms that you hear this on. I want to hear what you guys' feedback are on. If you have any questions at all, free to reach out to me at ramblingmindshow@gmail.com. I am willing to answer questions and walk through things with anybody that needs any kind of help doing this stuff, because I know it can feel complicated, it can feel overbearing, it can feel like a lot. So reach out to me, whether it's on IG, whether it's on Twitter, or whether it's just on email at ramblingmindshow@gmail.com. Also, you can go to my website and you can reach out to me on there as well. Except I'm gonna be honest, I am very US based because this is where I live. And so I may not be able to help anybody that's outside of the US because I don't know what those accounts are outside of the US. I may be able to point you to somebody who may be outside of the US that can help, but me, I cannot help you. I am sorry about that. But anyway, I'm gonna catch y'all up on the next one. Remember, generosity is always greater than greed. God bless each and every single one of y'all, and I'm out. Peace.